Welcome to the Asian Connection Mortgage Podcast, where we connect Asian Canadians together to talk about anything related to real estate, mortgages, and finances, based out of Vancouver. Our host is John Lee, mortgage broker with Arise Mortgage. Grab a bubble tea and enjoy the episode.
What is up, everyone? Welcome back to another episode of the Asian Connection Mortgage Podcast. And last time I talked about what I did in my 20s that led me to have early financial independence. So in this show, I'm going to share what I learned in my 30s. And it's crazy because I just turned 40. So I'm still trying to get used to having my age starting with a 4 instead of 3. But the good thing is that there's lots of things that are still pretty fresh that I'm sharing with you, and some things that I may have just recently implemented. So grab your favorite bubble tea, sit back, and let's get right into it. So I remember when I turned 30, it was actually quite stressful because to me, 30 is a big milestone. There's a lot of things that I wanted to check off on my list. So things that I had in mind would be, I wanted to get married. I wanted to look into having kids, have my career all set. Yeah, those would be the things that I have in mind, and really thankfully that those were all able to be checked off, thankfully. And another thing is also to hit that 100,000. So I remember I was telling my wife that I don't want to get married until our net worth would be 200,000. That's the goal I had in mind because I know getting married would be very stressful. Also looking to buying a home for ourselves. So I'm in Vancouver. It's really expensive. It's also very challenging as well. So with me being newly married, I want to make sure that the finances are all down packed. So at that time, I was working as a property manager, and the money was okay, but I transitioned to becoming a mortgage broker. And it's now been around 7 or 8 years now. And one thing that I guess I stumbled upon this. It's not like I really planned it because I really did not like becoming a property manager, but it's to develop a high income skill. So what does that mean? So I would say, like, if you want to become financial independent early, retire early, to me, in my opinion, it's going to be very challenging if you're an employee and you're trading your time for money. There's only so much time that you can offer. It's usually like what, 7.5 to 8 hours a day. And these companies, they will not pay you that well because the whole reason why they are hiring you is so that they are making investment. So say they pay you 50,000, for example, well, then they need to get at least 80 to $100,000 worth of return based on your work. So I was thinking about that. I was like, well, that's really not fair. Um, my skill offers 100,000, but yet the employer will only offer 50. So as a mortgage broker, well, that allows me to kind of, I would say, what, eat what you kill in a way. So it's all commission based, and per each file, generally I would earn about around 1% or so before any expenses. So as time goes on, this skill will allow me to uh, produce a higher income. And really, there's no shortcut to early retirement. Like you need income to funnel the money in and to save up to invest and so on. Without that, there's really not much uh other tools or anything that you can really take advantage of. So mortgage brokering, that is my high income skill. If you are currently an employee and you're kind of scared of transitioning, what I know other people do is they would have a side hustle, uh, some sort of consulting. I'm not sure. So you just have to figure out what is required in the market, what type of solution you can offer, and to sell your services. And people will pay if you are able to offer a solution to their frustrations, to their pain points. So I'll leave you with that. There's a lot of different side hustles that you can do. And if you do well, maybe it will eventually become your full-time job and you can quit your employee job and be able to focus all on your high income job. Now, that's not all though. So in Canada, taxes are high. Okay, so the more you make, the more taxes you will pay. So you will need to ensure that you are working with a good accountant and a good financial planner. So for me, one of the biggest things that I did to minimize my taxes is to incorporate. So that's why Arise Mortgage Corp, that's why I incorporated. It, it has grown to a team, but initially when I started it, it was just purely just to minimize taxes. And if you are incorporating, it does give you access to lots of tax benefits that aren't available to regular employees or even sole proprietors. You can defer your income, you can invest it back into your business. And it's also a lower tax rate too in Canada. So I believe last time I checked, it was, don't quote me, definitely talk to an accountant. I would say it's about 12 to 13% if you leave it in your corporation. If you make the same money, taking it out as personal income, probably 30 to 40%. So it really allows you to save up a lot faster. So definitely talk to an accountant, financial planner if you're at that stage. Because once you incorporate and you hit, say, 100,000 or so, and you have money left over, that's where you're going to be able to take a lot of advantages to save up and to earn a lot faster and keep a lot. The next thing is to take advantage of the power of compound interest and leveraging. So when I was in my 20s, the whole concept of compound interest didn't really make sense to me. Uh, it, I guess I understood it, but like if I only had like 10,000, but and I had like a really good return that year, like 10%, well, that's just like $1,000. Like, I mean, $1,000, what can you really get with that, right? But in my 30s, I had a more sizable portfolio and a 10% return on a bigger portfolio. That is a different situation. So you want to ensure that you stay invested, you invest in stocks. If you're not too sure about stocks, there's lots of ETFs. So ETFs are funds that could mirror, say, the S&P 500 or the TSX index. And they produce, I would say, in the long term, 6 to 8%. S&P 500 has been doing a lot better. So stay invested. The stock will go up and down, but in general, if you hold it for a long time, it does go up. And the thing is, in their 30s, you still have a pretty good time horizon for investment. 30, 40 years, like until maybe you decide to start selling. Yeah, so there's a lot of time to really write out all the crazy drops that may happen, like like 2008, uh, financial crisis. Like it has gone back up and more after that. But at that time, it was very scary. But don't sell, just invest the money that you don't need and let the compound interest do its work. But not only do you want to take advantage of the compound interest, you want to leverage. Okay, so leverage, I'm gonna go back. I heard Albert Einstein, so he actually calls like compound interest like eighth wonder of the world. But if you leverage and using compound interest, your money will grow even more. But it is not for everyone because if you leverage, it's like a double-edged sword. It could grow more, but you will also lose more. But that's also where the whole time horizon is. If you stay invested, then you can take advantage of the positive returns of compound interest and while leveraging. So with leveraging, what can you buy? So in Vancouver, lots of people buy real estate. And one reason is because in Vancouver, real estate market just keeps going up and up and up and up and up. And it just seems like regardless of whether or not you're an experienced investor, just get into real estate and you just make money. That can be true because if you look at the stats and the history, yes, prices have gone up, but it hasn't been like that. And also in other places outside of Vancouver and Toronto, real estate doesn't go up that quickly. But what is really good about real estate is that you get to leverage. So if you go to a bank, you can borrow up to 80%. If you're living in it, you can even borrow more. And the thing is, like, how leveraging works is say if you put 100,000 into a $500,000 property, and if the property goes from 500,000 to 550,000, well, that is a 10% return, right? So the property is 500,000, it has grown 50,000. But you only put down 100,000 though. So that's your initial capital, but you earn 50,000. So what that means is if we actually did the real calculation, it's not a 10% return. That is a 50% return. So putting down 100,000 and you earn 50,000. So that's 50%. So leveraging is huge. And that's why people love real estate because they get such huge return through leveraging while investing in an asset that appears to be quite safe, at least in Vancouver. Now, another thing that I want to share with you that I've recently found was that on top of real estate, you can also leverage financial assets, so stocks, ETFs, and so on. Now, generally, private banking from the big five banks, they will offer that option for you. Normally, they won't. If private banking is something that you don't want to get into, then there are margin accounts that you can take advantage of if you want to do self-directing. Of course, that is a lot more risky because you might get margin called, but no one is telling you to leverage the max. Give yourself a buffer. Like if you buy stocks of like a big bank, for example, like RBC, you can leverage up to 75%, but that's just the maximum. Leverage 50%. And RBC, if you take a look at the past, say, since inception, I would say its return would be about 12 to 15% with or without dividends. I'm not sure, but that will be around the range. But if you're leveraged, then that can actually get you maybe 20%. But remember, you're investing in like the biggest bank in Canada. Pretty safe. So definitely take advantage of leveraging. And it's not for everyone, but it is a calculated risk that can be considered to grow your wealth. Next would be to use insurance as investment tool, using it to protect your family and to use it to grow generational wealth. So lots of people, they have lots of different opinions about insurance. It's a scam. It's uh I don't know, lots of really diverse opinions. For me, I use it, it works, and I'm all for it. It's definitely an investment tool. And there are lots of investment products out there, but one thing that you should look into and talk to your financial advisor or an insurance agent is to ask about whole life insurance policies. The whole life insurance policies, why I think it's good is because there are some products where you will pay a premium and it offers a very high cash surrender value, even though you just invested it. So there's a strategy called infinite banking. So Google it. I'm not going to dive that deep into it. But what it is that you are basically double dipping your assets. So if you have, say, 100,000, you take that 100,000 and you buy insurance and then you draw it back out. So now you have two assets. One is the 100,000 that you currently have and you can invest in it. You have the insurance policy that's growing as well, and you have access to the equity and you're using it. So this is something that I found super helpful because when I turned 30 and I had my child, I was thinking about protecting family, but also generational wealth. So I was asking, I was like, what do rich people do? And what do they mean by old money? And what it means is that every generation bought insurance policies and they're huge policies. And what happens is that when the parents die, that big sum of money goes to the child. And the child then buys insurance again. And then when they die, and then it just gets go pass on and on and on and on. And that is what old money is all about. So definitely look into that. Next, I want to talk to you about is to maintain your standard of living while growing your wealth. So it's super tempting that as your wealth keeps going, growing bigger and bigger, bigger, you want to spend it and to splurge a bit. This will naturally happen, but what I would suggest is to try and fight it and try to maintain your standard living as much as possible. The reason is because if you one day decide that you want to fly business class, which is great, nothing wrong with that. But the thing is, that becomes your standard of living, and you will never ever want to sit in the economy ever again, even though there's really nothing wrong with sitting in the economy. So, um, if you are looking into early retirement, then you need to make sure that you are budgeting well and still maintain style of living so that you're not splurging on things that are unnecessary. And the last thing that I want to share with you, it's kind of contradictory to what I said just earlier. So now that I've hit my 40s, ever since I was a kid until now, I've had this mentality of delayed gratification. And I've been very disciplined, very good with maintaining standard lifestyle and so on. Well, now this whole idea of delayed gratification is not that important anymore. It is still important, but it's like how much more can I delay it? Because I just turned 40 now. So what I am telling myself is to just chill a little bit, relax, and enjoy the money that I've saved up, that I have invested in, and it's okay to spend. But it sounds crazy because people are like, "Oh, wow, you have a difficult time spending money? Well, let me help you with that." Like, serious joking. But for my entire life, where it's just trying to save, 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 to have this mindset switch is actually not that easy. Which I guess is okay because with enjoying the money, it could be a gradual increase. So yeah, it's just the mindset that I don't need to save every penny for the distant future. Everything is all set. I feel a lot more stress free, and I am financial independent now. So let's actually enjoy that financial freedom. So to wrap things up, lessons I've learned in my 30s to be financial independent by 40 are the importance of developing a high income skill. So think about that. How can you create solutions to the market and allow people to pay you for it? And once you found that out and you're making good money meaning that you're making more than you can spend, then you incorporate to minimize taxes, take advantage of power of compound interest, be okay to leverage, using insurance as an investment tool, and uh, also to maintain your standard of living while you are growing your wealth. And last thing is also once you hit your goals, don't try to chase more. Don't forget to enjoy the money that you've earned because in the end it is financial freedom. You should be able to feel that way and to be able to live the life that you want. So thank you for tuning in this episode. And I'll see you next time. Let's go.
Thank you for tuning in. If you enjoyed today's episode, please consider giving us a review and subscribing to our podcast on your favorite platform. Thank you for listening, and we'll see you next time on the Asian Connection Mortgage Podcast.